Hi, this is Mark Lewis from TTI, and I'm here to talk to you about the top 5 mistakes that novice traders make. And I'll give you a little clue up front. None of them relate to actual trading strategy. It's to do with the way in which trading strategies are implemented in terms of their money management. Now, this is a big area for trading, and it's something I'm going to go into in much more detail. However, for now, I'm just going to go over the top 5 things that new traders tend to do wrong. And they're very, very simple things that you can correct, and this is something that we can go into. We can show you techniques to prevent you from doing these 5 mistakes. So first up, we have over leverage. This is the primary mistake that new traders make. Before we go into details on it's worth covering exactly what leverage is. When we place trades with a brokerage at a currency trading brokerage in FX, what we're effectively doing is, in order to set the account up, we have to give them some equity. Now, we can then choose, depending on which brokerage it is and depending on how much leverage they're prepared to offer, we can then choose leverage. So if we run 400 to 1 leverage, that means that for every pound that you place into your account, you can effectively trade with 400 times as much, which is clearly an incredibly large amount of leverage, making you able to place enormous trades. But this is the one mistake that new traders make. They place trades that are too large for their account size. And there are techniques for calculating what is a safe amount to trade, and there are techniques for understanding exactly how to not do this, and we're going to be going into this in more detail. The reason that we shouldn't do this is because it magnifies your mistakes as well as your winning trades. And the reason this is a problem is because when you have a run of losses, it then becomes much, much harder to get back to zero because you have less equity in your account to trade with. So your account is smaller, and so you have to place smaller trades in order to maintain the same sort of ratio of trade size. And again, this is quite a complex subject, and we're going to be going into it in more detail. But effectively, over leveraging makes you much more likely to blow your account up, which is obviously what we're trying to not do. And it also reduces your overall profitability. In a moment, I'm going to show you an example of a successful strategy which has been made unsuccessful as a result of too much leverage, by placing trades that are too large for the account size. So let's have a look at that. Okay, here you can see we've got an example of 20 trades. Now these are just things that I've just stuck into a spreadsheet just as an example. So we have 20 trades on the left here. If you top these all up, you'll notice that there's a 50% success rate, so half of the trades are winners, half of them are losers, which, by the way, isn't an unacceptable success rate. This is typical of quite a lot of professional traders, that it's a bit of a myth that traders get it right all the time. When you become more proficient at trading, and for those of you that are more proficient and are more used to the everyday rigor of trading, you will know that you will lose money regularly, and the key to success is to manage the amount of money that you lose, and leverage is one of the key things to this. So in the green we have here, this is on the left we have white, and these are all the pips that are lost per trade. So here we have trade 1 and it's lost 100 pips, trade 2 lost 100 pips, and trade 16 made 100 pips. So this is in pip terms. So this is how far the trade went before it got closed, or before we took profit on it. We have a £10,000 account size, and we have up here, we have the percentage of the account won or lost per 100 pips equals 1%. This means that for every 1%, for every 100 pips, you lose or gain 1%. This is to do with how large the trades are that you're placing. So this is a very conservative amount. So 1% is a very conservative amount. And for those of you that are new to trading, this is where I want you to be trading, because this is the safest way to not lose your shirt. And if you look at the chart down here, you can see that even though we have a string of losses here, and we do lose some money, we lose in the region of about 5% of the account for this big string of losses. But in the end, we regain our composure and we end up making money overall. So we end the 20 trades with more money than we started, which is the name of the game. So this is a successful strategy. It's worth me pointing out here some very key metrics. The average win, if you tot all of the wins up and divide them by the number of wins, is 75 pips. And the average loss, if you tot them all up and divide them by the number of losses, is minus 65. So we are making more. Our average win is bigger than our average loss, and this is something that we should be aiming towards as well. So this strategy is reasonably sound, and it should make money in the long run, so long as we don't do anything too wild. And so we've made money, and so you might be asking, okay, well, if this is a successful strategy, well, how about we increase our risk tolerance? Why don't we place slightly bigger trades? Very good question. And this is exactly what we've done in number 2, in this yellow one here. So we have exactly the same thing, only this time we're risking 5% of our account for every 100 pips that we either win or lose. And so you can see this £100, this 100 pip, £100 one, has now gone to £500. And as you can see, we've taken, the account has dropped down to £9,500. And we've had another one. However, we now only have £9,500 left in the kitty, so our 5% is now much less, and so we're going to have to place a slightly smaller trade in order to try to get back to where we were. And so this is something that's a very sensible technique for managing risk as well, and it's something that we're going to be going into in much more detail later on. But if you follow this down, you can see that, okay, we lose more money in the losing streak, which makes perfect sense, but it all recovers, and we end up with more money than even the 1% one. And so this, by increasing our risk to 5% for this particular strategy, and by the way, it is specific to this particular set of numbers, so this is not a universal number. This is very specific to each strategy, and we'll show you how to understand how your trading performance is so that you can modify your risk settings. And as you can see, we've made more money than the 1% one, so we've improved our situation by increasing our leverage by a small amount. So this is now higher leverage and we're making more money. Okay, we're going to have to tolerate a bigger drawdown, which might be a little bit uncomfortable. We've lost quite a lot of money here. This is going to be quite stressful for you. And so if you have a higher risk tolerance, if you can tolerate this amount of loss, which is entirely dependent on how you feel about it, I would personally think that's a little bit too big a loss for me. But it's all down to your risk tolerance, and in the end, we make more money. So, I hear you ask, the name of the game is to make money, so why don't we just whack it up again? Why don't we just keep increasing the leverage of our trades? Because it's a profitable strategy, right? Why wouldn't we just place bigger trades and make more money at the end? This is what's happened in number 3, in this orange one. You can see that we're risking a huge amount here. This is 25% of our account per 100 pips. And so we're losing £2,500 on the very first trade at all, which is utterly terrifying. You would never ever want to risk that amount. And here's why. It's because if you see, the account size drops dramatically, very, very, very quickly. We have a string of losses and our account gets decimated. And that makes it incredibly difficult to claw your way back. If you look at the chart down here, you can see, I mean, this is awful. We've gone, right down below £3,000 here, from a £10,000 account. So we've lost 70% of our account in 10 trades. This is horrifying. And okay, it's made a slight recovery as a result of this string of wins. But at the same time, if we had a string of losses again at the end, and if you notice, this is actually making less money after our 20 trades. So increasing our leverage to too high leverage has actually made us lose money overall. And so if we had a string of losses now, we would then start the string of losses with almost £1,000 less than we started this string of losses with. And again, we have this red one just as an extreme example. So we've got 50%, which is just utterly bonkers. You would never do this. But, it's worth pointing out exactly why you don't do it. And as same sort of thing applies. If you follow it through, we end up after our 20 trades with only £3,866 left, which is a total disaster. But the interesting thing is, you will have noticed that there will be a sweet spot at which point, depending on how your trading is and depending on your success rate, your average win and your average loss, there will be a sweet spot of risk tolerance that is the most profitable. And it's definitely safer to be on the lower side of risk tolerance for that, because if you go past it, then you begin to lose more money than you make overall. And so we're going to go over a couple more mistakes. So